I've pieced together some solid data. And if you hold even one XRP, you need to hear this, because something's happening under the surface that could change how this market behaves over the next year. Not hype, not rumors, just facts and where they might lead. This is for educational purposes only, not financial advice. XRP has always played the long game. While other coins chase the spotlight, XRP keeps tightening its fundamentals. Faster settlement, cheaper fees, real partnerships, and limited supply. Let's start there. XRP's total supply is 100 billion. Circulating supply? Roughly 60.1 billion XRP right now, according to CoinMarketCap. The rest is locked in Ripple's monthly escrow releases, with transparent schedules on xrpl.org. So no, XRP isn't inflationary. It burns a tiny amount on every transaction, which means supply actually shrinks slowly over time. Now here's what's interesting. Exchange data from late 2025 shows shrinking XRP reserves, especially on Binance and Bitstamp. Binance's hot wallet holdings dropped several percent over the last few months, hitting multi-month lows. That means less liquid XRP on exchanges and more sitting in cold storage or institutional custody. That's not hype. That's a real tightening of supply. So where did the US states are buying XRP rumor start? It stems from genuine developments. The Digital Chamber of Commerce is launching a digital state network in 2026 to help all 50 states integrate blockchain into treasury and payment systems. Some states are experimenting. New Hampshire is linking municipal bonds to Bitcoin, and New York just allowed state agencies to accept crypto payments. That's real progress. But here's the truth. No US state has publicly confirmed XRP purchases yet. The interest in blockchain rails is real, but XRP's role is still potential, not official. Could XRP fit? Absolutely. It's fast, compliant, and designed for settlement, not speculation. But until Treasury reports or public filings say XRP, treat it as an opportunity, not confirmation. Let's run the math cleanly. If ETFs, institutions, and OTC desks start absorbing even 5%, 10% of that circulating pool, available liquidity could shrink dramatically. That's not fantasy. ETF momentum is real. Canary Capital's XRPC product launched in November 2025 with $250 million in day one inflows, the biggest ETF debut of the year. Bitwise, WisdomTree, and Franklin Templeton are preparing their own XRP funds. Analysts at CoinDesk project up to $160 million in daily inflows across these products once all 7 are active. At that rate, roughly $30 to $35 billion could rotate into XRP over a year, enough to tighten the float and trigger what analysts call a mechanical supply squeeze. Still, that doesn't mean instant moonshots. Institutional accumulation tends to be slow, deliberate, and hedged. But make no mistake, supply plus liquidity pressure are building in the background. Now, let's talk about Ripple. Because its corporate behavior tells you everything about XRP's long-term setup. Ripple raised $500 million in 2025, hit a $40 billion valuation, and made one of the boldest acquisitions in crypto history. Hidden Road Partners, a prime brokerage clearing over $3 trillion annually. That means Ripple now touches FX, derivatives, and institutional custody, the exact plumbing where global liquidity flows. Chris Larsen once called XRP the glue for globalization. He wasn't exaggerating. It's neutral, borderless, deflationary, and already ISO 2022 compatible. So why isn't Ripple going public in 2026? Because it doesn't need to. With revenue, partnerships, and balance sheet power like this, Ripple's playing the long game, absorbing infrastructure instead of chasing stock tickers. That's bullish, because it means Ripple can keep expanding XRP's use cases without public market pressure. Here's where macro meets crypto. Kevin Hassett, former Trump advisor and Coinbase board member, is the leading candidate to replace Jerome Powell as Fed chair if political winds shift. He's publicly calling for aggressive rate cuts, and Governor Stephen Moran is backing him. Translation: quantitative easing 2.0 is back on the table. That's new liquidity, and liquidity always chases yield. When dollars flood the system again, assets with fixed supply and strong use cases like XRP tend to attract capital that's hunting for efficiency, not speculation. If that aligns with ETFs and state-level digital adoption, 2026 could become XRP's strongest fundamental year yet. While these global rails evolve, another project is quietly building the next layer of liquidity. Meet Unich, a decentralized OTC trading platform built for early market access. It's already processed $1.3 billion USD in OTC volume and serves more than 5.5 million users across Web3. Unich lets traders buy pre-TGE tokens, swap OTC pairs, and access early deals long before centralized exchanges list them. It's designed for scalability with deep liquidity pools and seamless UX. This isn't financial advice, but if you want to explore how OTC liquidity works before mainstream markets catch up, check the link in the description. Here's what most holders miss. The tokenization boom quietly ties back to XRP. The World Economic Forum projects $16 trillion in tokenized assets by 2030, up from less than $500 billion today. Ripple's tech already powers CBDC pilots in 15+ countries, and its EVM sidechain connects 55 blockchains via Axelar Bridge. This means banks and fintechs can tokenize real-world assets, real estate, bonds, treasuries, and settle value instantly via the XRP ledger. That's the hidden demand driver. Every tokenized transfer consumes XRP for liquidity and burns a sliver of supply. Even if tokenization adoption reaches just 1% of global capital markets, that's trillions in settlement flow, far beyond what retail speculation can move. That's why analysts call XRP a liquidity asset, not just a coin. ETFs are more than exposure vehicles. They're psychological gateways. When Franklin Templeton, Grayscale, and Wisdom Tree launch crypto ETFs, they don't do it for hype. They do it to park institutional money safely. Canary Capital's $245 million day-one inflow was just the preview. Bloomberg ETF analysts now project $7 to $9 billion in total XRP ETF AUM by mid-2026 if approval momentum continues. At that scale, ETF issuers would collectively hold 3 to 5% of total XRP supply, effectively locking those tokens for years. That's structural scarcity. And institutions love that. Why? Because predictable scarcity plus liquidity equals controlled upside. And controlled upside is what big money prefers, not chaos. Quick update on Unich. Their UN token IDO is now live. It's a low FDV launch with referral rewards, NFT perks, and on-chain transparency. Unich positions itself as an over-the-counter liquidity layer designed to capture pre-market and institutional flows before major CEX listings. Again, not financial advice. But if you're researching early market infrastructure, Unich's white paper is worth reading. Links below. Let's wrap this up with clarity. XRP's total supply equal fixed. Exchange reserves equal shrinking. ETFs equal building. States equal exploring crypto infrastructure. No confirmed XRP buys yet. Ripple equal expanding globally, skipping IPO. Macro equal turning risk on. That's not hype, that's alignment. So is there an XRP supply shock underway? Not officially, not yet. But the conditions for one are forming right now. Stay smart, stay early, and remember, you don't need predictions to profit. You need perspective. If this breakdown helped clarify the noise, hit like, subscribe to Wealthy Wise Finance, and comment below with your own take on the XRP supply squeeze. The next phase of crypto isn't about hype. It's about infrastructure. And that's exactly where XRP is winning.